Hello and welcome to this very special Diwali series on the Wealth Formula. I'm Mahalakshmi and I'm joined by a market veteran, Kenneth Andrade from Old Bridge Mutual. Thank you so much, Kenneth, for joining me for this very special edition on Moneycontrol. First of all, very happy Diwali to you and the entire Old Bridge family.
Thank you very much, Mahalakshmi. I wish you and the entire team and all the viewers out here the same. Have a wonderful festive season.
Thank you so much. So the blockbuster conversation we are going to have right now is Three Idiots. You wanted to talk about. You have a bit of a contrarian streak. You don't go with the crowd, and that's of course the underlying reason why you've built such a fantastic track record of returns. So, what are your three contrarian bets? And if I could start with one. I see that a conspicuous absence of financial names in your portfolio. And I can't think of any other mutual fund which does not own any bank stocks except for one NBFC, which is Shriram Finance. You have no bank stocks, no insurance, no other non-banking, no asset management companies, your own business. What is it when the world is actually, most fund managers I speak to are very, very bullish on this one sector? What makes you pessimistic on this?
So let me try and encapsulate this together. One is from the industry from the marketplace that exists. And second is what are the objectives of the one portfolio that we run, which is the Old Bridge Focus Equity Fund. Right. So from a marketplace, if I just scroll through all the names out there, including the industries out there, banks are a very integral part of the market. It would be upwards of 30% of the entire marketplace today. So it's a great place to be in, especially after 6-7 years that industry has consolidated itself. Business models have become more robust, and valuations are also relatively more easy to digest today than they ever were. Okay, I think that's where financials or the lending businesses are currently, or even the insurance businesses are currently. And then I switch on. So from an asset allocation standpoint or from an allocation standpoint in an equity portfolio, they should find a place. Okay, where we come from in the focused equity product that we work with, our idea about putting stocks in or putting opportunities and picking stocks in is one, the total addressable market, and we look at it a little differently. The total addressable profit pool has to expand disproportionately. Okay, from an industry context, and once you've been able to identify that, you find a couple of businesses that address into that pool. So we're trying to have a buy and hold strategy which will compound reasonably ahead of the entire market cycle. Okay, and that's why the disconnect with some of the large industries within the marketplace and within our portfolios do exist. Okay, so 2 or 3 things that need to work for us. We need to get businesses cheap on an absolute basis. Now, when I say absolute basis, they need to be closer to replacement cost, book value, etc. Right. Second is they need to be category leaders. All right. And once we identify with both of them, okay. The third thing is the industry should be going through a down cycle. Okay. And once we can pick a company, a business cycle, okay, and valuations, I think they form a part of our portfolio. I know there'll be a lot of questions. Is that we've got our top 5 companies out there are mature businesses. It's a very competitive landscape, but the alignment of what we're trying to do in our portfolio is these are businesses that have been, or companies that have been on our portfolio for almost over 5 years. You need to watch as to what's coming in at the bottom end of our portfolio and how we are constructing a portfolio from grounds up. So if you're a new investor coming in and you're watching our style of investing, this is essentially what we're trying to capture. Great valuations, category leaders, and I mean category leaders.
Right.
And obviously when you buy them, they have to be solvent. And then the total addressable market or the total profit pool is set to expand disproportionately. Okay, and that explains banking or some of the larger categories of businesses out there, and that explains what we are doing.
Okay. So from your portfolio perspective, I can understand that, some of the businesses you have, you expect profit pools to expand from here. But please explain to me, you're saying that the profit pools in the finance industry is not going to expand. Like one of the businesses, since you are also from the industry, asset management companies, wealth management, broking, maybe not so much, are definitely, uh, don't you think they have a long runway to grow? I mean, looking at the participation of households, or how India savings is likely to grow, how much of that will come into capital markets? Don't you think those bets have a huge opportunity for expansion?
Of course, I did say that these are companies and businesses that have matured cycles. Okay, they are available at valuations you can currently digest. But is that profit pool expansive disproportionately? I have my reservations right now, especially in the lending business that is out there. Okay, because today I think our lending book with the banking system is very close to our GDP numbers. Okay,
Okay.
and you got market participation in terms of growth, or you get GDP participation growth. It's not that you wouldn't find a company that would do disproportionately well. We are always on the lookout for one particular or two particular businesses that do particularly well, and we'll align with that. But we're not in the position of allocating capital to a sector because it's a part of the industry. That also rules out the fact, I won't say that rules out the fact, that doesn't rule out the fact that we will not look at some of the companies or some of the industries which are, so let's look at it this way. Insurance hasn't done anything for the last 5 years.
Right.
Okay, but when all the companies were getting listed, okay, there was a lot of excitement about these businesses. Okay, but you've gone through one learning cycle of what could go right, what could go wrong, and how incremental amount of competitive intensity cannot be good for your profitability. So it's
That's
an
right.
industry which is fragmented itself. That means limited limited profit pool, more number of participants.
Right.
And when more number of participants starts feeling the heat, the industry starts consolidating. I think that's where we like the business to be in. And I've said this because at all points in time, every industry is on our radar, especially if it's not done well in the last couple of years, both from a price point standpoint and both from a profitability matrix standpoint.
Right.
As long as companies continue to get market share, they're consolidating the business. So don't rule us out from investing in this space. I think you will find us there. Find us there, but we like to wait on the sidelines when a business is extremely hot and valuations are not on our favor.
But in banks, you can't really say. I mean, I can understand for asset management company, even though you have seen correction, you can still argue that maybe stocks are a little overvalued. But banks, would you say they are overvalued today for you
No.
to sort of?
I think they're very comfortable in terms of valuation, but
But you are just seeing that the profit pool will continue to get fragmented because of competition.
it's not just fragmented. I think if you go back into history a little bit, when privatization of banking system actually moved out, there was a large opportunity for private banks, which happened. They got incremental amount of market share, or they got market share from the public sector.
That's right.
And when you got market share from the public sector, okay, you showed disproportionate amount of growth, you showed disproportionate amount of profitability because you're more efficient, and I think that journey is behind us. Okay, and then if you look at the near term numbers that are there and see historical last 3, 4, 5 years, wherever it is, your incremental amount of efficiency of capital efficiency or ROEs have trended downwards. So profits increase, capital efficiency is trended downwards. I think that's what we've avoided, and that's what we tend to avoid. Any industry which is large, continuing to grow at nominal GDP growth rates, is not a place that you'll find us.
Understood. So, so you would want prices to reflect that, and right now prices are not at that stage. Is that what you're saying?
How do you make money? I mean, when we look backwards from 2020 and look at our CAGRs, they're off the charts. So what happened in 2020? The only thing that happened in 2020, irrespective of which industry you invested in, okay, price was in your favor. Okay, so in multiple cycles, in multiple years, in multiple cycles, you will always have to wait for your turn, okay, to identify a particular business which is very close to your replacement cost cycle, but markets ignored it, or market refuses to participate, waiting for the growth curve to come back. We like a company when it's, or like a company, like a business, like an industry, when you're very close to a replacement cost cycle.
So in the context of services, or in the context of finance, what do you mean by replacement cost?
One time price to book and below. As long as you're earning more than your cost of capital.
Right.
I mean, it's not finance or anything. It's any business that is out there.
So you are not you are saying that you will buy a bank for whatever is there in the balance sheet, and you're not going to pay anything for growth.
See, when growth kicks in, that's when I make a money as an investor.
By that logic, you would have never bought an HDFC bank ever in your life, because it was always quoting at higher price to book. But the stock did.
You can say that about a number of
phenomenally well,
industries, right? You can say that about a number of industries. And
No,
in
but
my career,
I'm saying the length of outperformance of a company. Of course, last 5 years have been bad, but I'm saying for 20 years you could have argued that the valuations were high, but
so if I step back, you will get all the data out of it. Okay, so there were periods of time where we allocated sizable amount of capital to financials. In my career, I mean, if I remember right, in 2011 we had a portfolio in my previous role, which was only a financials portfolio. Okay, and they were private sector financials. Okay, so there's nothing which is outside the entire domain. The thing that we can't predict.
So those periods where when you were expecting disproportionate gain in terms of market share and profit pool, is that what you're saying? You could see near-term visibility on
I
these
had
two
pricing
counts?
in my favor.
But one-time book, I don't think one-time book ever any of the private sector banks would have traded, except for maybe, when the wholesale banking crisis happened, maybe, ICICI Bank or some of them could have gone down before price to book. Price to book for private sector banks in India was very...
Let me put it this way. We're getting stuck with banks.
Right.
Okay. Let's take another business that has done extremely well, and everyone says it's a business that creates billionaires into millionaires. Okay, we know what we're talking about, right? I mean, India's largest airline has created an enormous amount of wealth in the last 5 years. Where did that growth come from? It came at the expense of the rest of the industry.
Right.
So if you track data and if you track numbers and go backwards, passenger growth 2019 to 2025 has been an anemic 6-7%. Okay, but look at the way the stocks compounded, look at the way profitability is compounded, look at the way pricing came back.
Right.
Okay, so what did I have in my favor in 2021? Okay, no one's going to travel.
Yeah.
The rest of the airlines are getting bankrupt.
Right.
Okay, and there's one business out there who's still solvent and incrementally getting market share.
Right.
Okay, if you ask me with the same lens to look at the business today, at a 65% market share, there's only one way it can go. It can lose market share. Okay, it's not. I'm not saying that the business is bad. The business is phenomenally on rock solid footing. But if I go back to industry growth rates and saying you're going to do an anemic 5% passenger growth rate in the domestic market, your opportunity is sitting somewhere else.
Right.
Okay, that opportunity has to be defined. Okay, and you got to be very convinced that that's going to add incremental amount of capitalization, which is linked to profitable growth.
Right.
So those are the constructs that come through. So it's not got to do with one industry versus the other industry. See, I'm a money manager out here. I buy efficient capital at a price.
Right.
Okay, and I've got 10 industries, and I've got 3,500 companies to choose from. And the way the IPO market is, I mean, I'm sure that number is going to increase quite disproportionately over the next couple of years.
Yes.
So how do I choose 25 businesses out of that? And that is the objective of what the fund does. I am not looking at a 100% strike rate in my in the portfolio. I am not looking to be at every party that happens at all points in time.
Fair enough.
Okay, I've got to choose what I think is right or what we think is right from a vantage that we see it, and replicate that in the portfolio. So it's a
Sure.
thought process which is imbibed into the entire portfolio.
Sure, sure. So tell me the three idiots that you have in mind.
Relevant question, but I think I'll start with the fact that we've from where we started the conversation with financials. So if I don't have 30% financials in my
Yes.
portfolio, it belongs somewhere else, right? And one of the largest exposures today is about pharmaceuticals.
Yeah.
And pharmaceuticals and manufacturing. Okay, manufacturing linked pharmaceuticals, which effectively is every company that is putting significant amount of capex to work for a marketplace which is bigger than 3% of India's GDP, for a population which is bigger than 20% of the world's population. That's the place that we are in. So effectively, it's generic pharmaceuticals, contract manufacturing, outsourced services, the entire gamut. And I think that's where it is. What do we see out there and where we are? I think I go back to our investing style as it looks for a disproportionate growth in the total addressable market or the total addressable profit pool, and allocate capital out there. Okay. Second is where the valuation spectrum is. Okay, there was one transaction that happened globally. Okay, wherein one of the private equity companies in the US went over and bought a company called Zentiva. Okay, if I'm not mistaken, that was about 11 times EV/EBITDA.
Right.
Okay, you got a floor on pricing set there, and look at every business which is close to that number, and you know that you're buying it somewhere across replacements. Okay, characteristics of every business will be different, but once you've established a flow, as an investor you can choose to pay whatever premiums you want to pay for an industry which is outwardly facing.
But why do you say that is the floor? Because that is just one transaction. Why would that be a floor? You can make, I mean, there are so many acquisitions that get made at the wrong price also.
Sure, but that's what the number I have to work with currently.
Okay.
Okay, and when you look at a 10 times EV/EBITDA, it's a 10% yield on your profitability. Okay, if you want, obviously it can get got done lower, which in one of the auto businesses has happened. But that's a cycle that's getting put together. Okay, can I find another investor to buy out a business which is equally large at that price earning multiple? Probability is that there are bidders in the market today.
Right. So that's your pharma call. Largely.
So I got my pricing right. I got my total addressable market right, and then you have to choose businesses that are category leaders or dominate the rest of what they're trying to do, and I think that's what we're building through, or what we built through on our portfolios.
Okay, so your Glenmark, for example, is not it's not a research play. You have Auto Pharma, you have Glenmark.
This is the other one. This is the contract manufacturing business.
Right.
Okay, it's not the Glenmark or the Glenmark that you know.
Right.
Okay, this is the one. This is the smaller one out there.
Right.
Out there, it's a business that came through where valuations are perfect or next to perfect, and it came through in very troubled environments. It's also a business which has changed hands in terms of management. Okay, and it's also a business which has now expanded its landscape significantly from what it used to do.
Right.
Okay, and it's put together a capex cycle which is equal to his existing cash flows. So he's got financial discipline. He's got an expansive marketplace. The total addressable market for him is completely shifted upwards.
Right.
Okay. The only thing we got to establish out there that he's got leadership out there, but within his categories and within the products that he dominates today, he's got category leadership even out there. Now it's a tiny business. It's no way you can predict. You can for a normal investor to to understand as to whether he's got category leadership in every molecule that is there, but he's got a dominant market share in each molecule that he's present in.
Any risks for these companies? How do you view this tariff war playing out? I mean, are there any risks related to pricing, tariffs, etc.?
So whenever so in any business or any category, especially if you're working out of a country like India, okay, or in the 90s, if you were working out of a country like China, or say in the 80s out of Korea, or before that in Japan, you got to establish one thing which makes you competitive despite everything globally. You have to be the lowest cost manufacturer, come what may.
Understood.
Okay, because the only success that you have, okay, the only success that you have and maintain is your ability to sell deflation into the rest of the world. Now that's a generic statement. Okay,
Yeah.
don't hold me by that. But you have to remain the lowest cost manufacturer in the world to get incremental amount of market share.
Right.
Okay, and you have to be the lowest cost manufacturer even to get market share in India.
Right.
Okay, so how competitive can you be? Because these are not consumer facing businesses. These are all
Right.
B2B businesses.
That's right.
Right. And once you've been able to establish that, those capabilities, I think your business models to a very large extent become infallible compared to what the rest of the world could do.
Right. So these are companies you're saying they are immune from cost pressures
No,
in a sense.
they're not immune from cost pressures. Their margins will react to that. Okay, but in the longer term, can they use existing cash flows to build other streams of business? See, the investment cycle for us is like you invest in one business, it makes money, take it and put in another business. For an entrepreneur or for a business like this, you generate an enormous amount of money, you take that money and you put it into an extension of your business.
Right.
Okay, and that's the life cycle of a company that goes through. I think that's how we look at each individual company, because our holding cycles are relatively a little longer than. As I've seen my career grow, our holding cycles in individual businesses become longer. So we have to make sure that the reinvested capital also adds significantly to our reinvested capital that the company does, de-risks his original business that is there,
Right.
and adds reasonable amount of value with a higher addressing a different total addressable market. So that's how we try and build it out for them. So tariffs are a risk, but in the medium term it will affect margins. By that time, I hope a lot of these companies that we invest in will be able to find different business models and business to grow into. Okay, if we don't, obviously a lot of them will come up for a relook.
Understood. And so fine, that's pharma. So again, this is an overlooked part of pharma because there is so much conversation about other segments. What is your second one? Another notable thing I saw was metals in your portfolio. Is that what you want to talk about? Again, looks like a contrarian bet to me because you have Tata Steel, Hindalco, Hindustan Zinc. I mean, Tata Steel is at the lower end of its earnings cycle, perhaps. And markets are perhaps ambiguous about the global demand supply and price disruption. How does it fit into your framework?
So here it's a little bit of looking how these companies have operated in the past and the humps or the challenges that they've actually come across, and how the cash flows are now ahead of the capex cycle. Now this might be an audacious statement, but if I go back, if I look at, if I just push forward to 2030, some of these companies out there, purely because their cash flows are ahead of their capex cycle, they will have balance sheets better than India's largest FMCG business.
Right.
Okay, so they're no longer the cash guzzling companies that you used to know them as.
Right.
Okay, the caveat out here is management don't go out and do something dramatic like they've done in the past.
That's right.
There's obviously an investing risk in any company that makes disproportionate amount of profitability. The near-term challenges is some part of this profitability is subsidized. Okay, and that's because of import duties, etc.,
Yeah.
etc. And in the long term, a lot of these businesses go back to single-digit margins, which is seen by all large steel manufacturers across steel metal manufacturers across the world. So those are long-term challenges, those are near-term challenges. But our mid-term point of
Theory.
view of these companies is that we wait till that cash flow cycle becomes so significant that cash explains the enterprise value of those companies. Okay, so theoretically, if a business trades at about 2.5 lakh crores of market capitalization, and in the next 4 years they can generate between 50,000 crores to 1 lakh crores of cash on book and pay off all their debt, you're looking at a business wherein the enterprise value of that business is significantly explained by its ability to generate more cash every year. How do you value cash? I think those are things we'll get to when we come there.
Okay, so what is your theory on metals? All these three, is there a common thread, or are you saying that these are at a point in their earning cycle where next 4 years of cash flows will equals today's enterprise value? Is that what you're saying?
We hope so. You're close, but it won't be equal.
Okay, okay.
Okay.
So 4 5 years of profits, so that's a big up move.
Uh, if we also get a great commodity cycle, which you don't project, which I don't think we're in the business of projecting, I think it will be much earlier.
So what is your fundamental call, that metal prices will go up?
No, nothing. I'm looking at the business model as it is currently stated.
So based on current prices,
Yes,
current metal
current,
prices,
current.
just purely based on demand
Uh,
or consolidation. What is the theory?
so it's a little bit of both. We're growing fairly well as far as demand for metals are concerned, whether it's domestic or international. We've got we got cost competitive. We're cost competitive in nature. Obviously, there's an international price disrupt out there, so we are not very competitive on the export part of the market. But if you take out if you take the elephant in the room out of that, which is basically the Chinese, I think we're the second best to in that industry. Now, that is something that we can't predict, but cash flows are protected. So if you look at the ferrous metal space or the steel space, I think we operated between 7,500 rupees EBITDA per ton to 25,000 rupees EBITDA per ton. I think we will be running close to about 13,000 rupees EBITDA per ton. So you're closer to the bottom of the entire cycle in terms of profitability. Even if you go back to 7.5, you won't lose money.
So, Kenneth, in periods, I'm just trying to recollect, but in periods where, despite the import duty, when there is pressure because of dumping and Chinese dumping and stuff like that, do stocks really perform?
No, they don't.
So how are you saying, is this not a persistent pressure?
It will be.
So,
Which is why you're getting it
which
at
is
the
why
price.
I'm trying to understand, how are you projecting like 4 years of such significant cash flows if the prevailing environment in terms of Chinese availability or dumping continues? You can still assume that government will continue to protect the industry by levying tariff, etc. Then what is the case?
Okay. So there are two parts of the question, and I'll take a little bit of I'll take a step back. Okay, when you have good news, you have elevated price earning multiples.
Right. Agreed.
When you have bad news, you have depressed sentiment and you have depressed valuations. We are at that point. Okay. Can I predict good news in that sector? It's not or should I say that
You're
I'm
not in a
hopeful,
position to
but
do that.
I am not. I'm hopeful if it comes through. The thought process that we've aligned our investment thought process will come through much earlier. Okay, so I'm not in the business of projecting whether China will stop manufacturing steel, and that's not what I'm doing. But with the existing stress in the underlying environment, does cash flows from this business make a good opportunity to look at?
Right. And
We think it is
so the market is not recognizing. I think your primary call is that the market prices today are not giving enough credit for the potential cash flows that is possible in the next 4 years.
Yeah, yes, that may be one of the cases, but there are two sides to the equation. There's no good news means there's no buyer to the stock.
Okay, fair enough. So that's your metal story. Um, would you want to give a third one? I saw your portfolio and I have another question, which is you have a lot of these, consumer stocks, small consumer stocks. You have Barbecue Nation, you have Burger King, you have Radico Khaitan. Of course, not all of them have different stories. But today, markets are far more excited about Zomato, and of course, it will not fit into your price criteria. But tell me the thought process, because for all practical purposes, I was looking up, like, Burger King or a Barbecue Nation is also hugely loss making. If you look at earnings multiples, it will be miserable. Some of them also have huge debt. So, you certainly think that they are very good turnaround candidates, so to speak.
Uh, so, so you mentioned three names. One has done enormously well over the course of the last 5 years or 6 years,
Yeah,
and
yeah.
and when I say 5 6 years, our mutual fund is in existence for the last 15 years. And prior to that, we used to have an alternatives business wherein the portfolios um, had continuation into the mutual fund, right? Uh, so when you- so you have to go backward to go forward. Okay, and we are talking about a business in today's continuity, right? In the liquor business, the business was very simple. At 1,500 crores, nobody wanted to buy this business.
Fair enough.
Okay, and that was not very far back. That was about 8 years back. At 1,500 crores, that business was at 1,500 crores at that point in time. Today, it's about 40,000 crores in market capitalization. Okay, that's an enormous amount. What was he doing right at that point in time? Okay, I go back to the same thing. Well, price point was right. No one believed that it could be executed, and the business model was just about beginning to evolve. And all of this was in public domain. Okay, it was just his ability to execute right,
Right.
for me to get my price right, and you participated. Now, when I look backwards, okay, this business would be trading at 3 times price earning multiple in 7 years back,
Yeah.
which is today 100 times price earning multiple
Correct,
today.
correct, correct.
That's the equation. Now, fast forward today, I got to get my pricing right. I got to get my categories right. Okay, and I have to make sure that the industry it's not a company problem, it's an industry problem. Okay, and in the life cycle of every QSR, this is the worst phase that they're going through for a very long while. So everyone puts it down to competitive intensity. Okay, everyone puts it down to fragmentation. Okay, the the moot point is that the industry can't get footfalls. Consumers, that category is struggling.
Right.
Okay, for multiple reasons, it's a struggling industry. That's exactly what we need to look for. So when a business doesn't do anything for 5 years, there's a misallocation of capital in some of these companies. They've been able to rectify some part of that all. Okay, we just have to wait for the cycle to actually play out. Unless you believe that Indian consumers, which is basically a population which is 20% of the global population, is never ever going to come back.
Right.
Okay, because our long term cycle, and this could go for every category under the sun, is at $2,500 per capita GDP. It has to go higher. Okay, and that creates a discretionary basket. Okay, which some businesses will benefit disproportionately from. So I think that's the cycle that we're looking at from a macro standpoint. From a micro standpoint, I think the profit pool could be significantly large out there. Now, which company is going to benefit disproportionately? We've taken our bets on a couple. It could be someone completely different, but it's not that these companies won't participate in that cycle.
Okay. So, two questions. One is on the liquor company that you talked about. Going back 7 years, definitely, one couldn't have predicted it, but it fit into your equation of secular growth story plus very very cheap valuation multiples, etc. But today, where does it figure? Today, at 100 times valuations, with so much growth, you're counting on so much more, and the pace to perhaps accelerate from here on.
Yeah, so from an investor standpoint, and we're an investor-run portfolio. I mean, I'm an investor in my own fund, and I've been running portfolios based on the fact that these are companies I like, these are companies I believe in, and I put
Understood.
out there. So I just like to put this out on the table. At when you buy a business at a certain valuation, say 10x valuation, and you buy the same business at a 40 times valuation, you're not the same person.
Yeah.
Okay, you're not the same person. So always look to what we're building in the portfolio, rather than look at the top end of our entire portfolio. The top end of our portfolio are companies that are completely matured. Okay, so to answer that a little, that's not a part of the market that we are allocating capital to anymore.
Today, right. Fair enough. These are past winners that you like to continue because you still believe in their growth story for stability or whatever.
So the science of from our perspective, our science or art of selling a stock has been awful. Okay, I mean, it's been awful because when we first started off putting a portfolio to place, I mean 2018 and 2019, we had investors coming to us telling us that the consumer economy is the only place to put money into, and India's largest private sector bank is the only place to look to, and we were allocating capital to a utility, to a cable company, to a power cable company, to infrastructure businesses, etc. Because in our mind, you're buying a capital efficient business, even if it's at 14-15 times capital efficient, and at a price to book of at a price earning multiple of under 10 times. Okay, so it's a low growth, low ROE business, but you're buying it at a historical low in price earning multiple. So that's our methodology. And I just repeat that: how do you allocate capital to something that's at 40 times earnings? Because for you to sell it, you have to believe it will go to 60 times earnings. And that is not our skill set.
True.
Okay. So obviously, if you fast forward it till today and move forward, you have to look at your business in the business, and you have to have a visibility of companies that will do well in, say, 4, 5, 6, 7, 8 years, right? And I've also got companies that I bought in 4 years back that haven't done anything till now.
Right.
Okay.
Do you allocate more capital to them now, incrementally?
Yeah, of course. If the stock prices continue to go down, and from an execution point of view and from a industry point of view, the fundamentals get much better, we necessarily have to keep allocating out there, because that's the investing.
Right.
That's how you invest incremental amount of capital.
Understood. So what are your bets with respect to these two restaurant companies that you own? So structurally, you think that this is only a temporary problem, that the footfalls are not happening. But wherever you go to the malls, and wherever you go, here also there is a problem of fragmentation, right? There is so many, not just because of delivery and Zomato or Swiggy, home deliveries. It is also in the restaurant space. You see, there are so many restaurants that keep mushrooming in. So how do you feel confident that these one or two players, is it the execution track record, or what is it? What is your real play on?
So if I was that confident, I'd just buy one company.
Bigger part.
I'd just buy one company. Okay. So when we put portfolios to work, it's a probability of getting a maximum amount of them right. Okay, and if you are at a ratio of 55% right and 45% not so right, the other 45% you shouldn't lose money on.
Correct.
Which is where the valuation metric comes in.
Right.
Okay, and then your top percentile in terms of performance.
Right.
So we try to do two aspects of it all. First, we try to not lose money. Okay, and then the other 55% is like or over longer terms, the other 55% has to make money on it.
Okay. What are the other calls that you are more confident of?
If they are not
They
in
are
my portfolio,
contrarian. I mean, in your
if they are
portfolio,
not
they're
in my
contrarian.
portfolio,
A
they're not
contra.
there.
No, your confidence can also be in stocks that you are not, that are not in their portfolio for the purpose of this show. That your highest conviction that these will go through misery.
Uh, that will go through a misery.
Yeah,
Oh,
I mean,
okay. Yeah.
otherwise they will be in your portfolio. I mean, if you think the other way around, it should be in your portfolio.
Yeah. So I sense that we will struggle with the consumer economy, with a consumer-led economy. We're not there as an economy to be led by a consumer, right?
What do you mean by that? Consumer-led economy meaning?
Yes, because there's been a lot of allocation and there's a lot of optimism that the consumer cycle is back.
Correct.
I will have a certain amount of reservations on that. It'll obviously whatever has been done has been picture perfect. Because from an economy standpoint, given that there is stress on incomes,
Yeah.
okay, you have to drop costs. But it'll keep the GDP in momentum. The segment of the market will keep the GDP in momentum. In the next 6 months, I think we will have to find another story to keep the GDP in momentum, and that could be government spending. Right. So this near-term visibility of 1 quarter, maybe 2 quarters of consumer spend coming through, it'll come through. Okay, but I doubt it. I doubt its longevity in the entire process.
Why do you say that?
Okay, incomes are under stress. Okay, so whatever is happening globally,
Which class of incomes?
no, whatever is happening globally,
Across.
whatever is happening globally. So let's put it this way: okay, if you go down south of India, okay, which is in inverted comma one of the highest per capita GDP
Yeah.
economies out there, there's wage deflation for whatever is happening outside the world.
True.
That should answer most of the questions out there, right?
So textiles. Essentially the export-led sectors.
Everything,
Labor
everything.
market is
Services, manufacturing, etc. There's been a disruption in the cycle. I'm saying a disruption in the
no.
cycle.
Explain more.
No, there's a
Disruption in the
disruption.
cycle meaning?
There is stress on incomes because the ability of you to be competitive in the world is based on the fact that you get a lower wage.
Fair enough.
There's stress on wage. Which is where the optimism on that consumer cycle may be short-lived.
But people also think that, generally the market and even businessmen think that this is a, transitory phase. Maybe the tariff issue will get resolved in a quarter or two, and then, you might be back. So is the way you are thinking about it sounds like this is more longer term, because you're saying for 1 or 2 quarters, government support will help, but the stress will continue for a longer period.
So let's look at it a little from a corporate or an industry point of view. Once wages go down, they stay down for a while.
Understood. So you're
Okay,
saying that all
so-
sectors. So this is only the employment in the export-led sectors, or you see wage
There's a whole
deflation in
economy. There's a whole economy set on the back of it. It's been a GDP multiplier for South India.
IT services?
It's been a GDP multiplier for South India, right? So you can't take it away. I mean, if there's a
So
multiplier
that will
effect on
continue
the
to
upside,
see wage inflation, deflation. You see.
so I'm not saying. I'm saying that wages will be under stress.
Okay.
Okay, it is not something which is perpetual in nature, but it is there in the medium term. Okay, and then we will have to get our act together. The biggest problem for a country like ours is that we haven't put capital to work.
What do you mean by that?
Okay, India INC has not been investing in creating jobs, opportunities. Okay, for a multiple number of reasons. Okay, and I think that needs to come back again.
So you're not bullish on electronic manufacturing, because there is at least some good news there, and that is away from all this tariff conversation, also out of that ambit. So you don't feel bullish about that
There are
part
two
taking
extremes
off.
of it. Electronic manufacturing and manufacturing is going to be very good for the country is not going to be very good for investors in the near term, because most of the valuations are already on the stock price.
Fair
Most of
enough.
the optimism is already out there.
Right.
Okay, when you scale up manufacturing, like you scaled up IT services, okay, you had to scale up IT services because you had to get the right talent,
Right.
which was not available. You created talent. Manufacturing is on that journey of starting to incubate training institutions within their premises to
Right.
create the talent and build it forward,
Right.
which is where the next growth of wages will start happening or may start happening.
Right.
So whatever we are encapsulating out here is probably for the next year, 2 years.
Okay.
Medium term to long term, I think we are the best placed in the world today to export, um, to be competitive in any product which can be manufactured. Okay,
Sure.
without subsidy. Without subsidy.
Right. Right.
Okay, a little bit of help from a subsidized environment, and a little bit of help from industry that realigns to work with lower ROEs.
Right.
Okay, we'll see a sea change in the way uh, the way manufacturing or any other industry could transition to.
Right. Looping back to the point you started, which is that, you are bearish about, consumer economy and consumer related stocks because of this wages being under stress.
Okay, I would not want to use the word bearish.
Okay. Now that you are in
It's
the
not
mutual
a
fund
format.
industry, you
No,
can't
no, no,
use
no,
that
no.
term
I don't
bearish.
think so. I don't think so. Okay. See, as an economy, we will always grow at between 4 to 5% even if we do nothing. Okay, so you can't be bearish on the country. At 4% and 5%
No, fair
GDP
enough.
growth, you
I'm
can't
saying
be, and
consumer
at 7,
stocks.
8, 9%, you can't be bullish about it. Okay,
Right.
because we will always operate in a band like that. So in consumer stocks, you're not bearish about it. You're apprehensive that the excitement that is there in the marketplace at this point in time, it may not be a secular trend, is what I said.
Okay.
It's got nothing to do with me being in a mutual fund or not. It's showing up in my portfolios.
Understood. Understood. Then how come Maruti is your top bet in your portfolio? I think it's the biggest weight.
Yes, look at it. Look at it when it came in, and look what happened before that. 4 years it did nothing. 5 years it did nothing.
So as a stock, you could still pick consumer companies, which you are. Of course, you have a bunch of companies, but
In banks, you will still be able to pick a company.
so based on this consumer related stress, what is it that you're avoiding?
Virtually everything.
No, but these are all restaurant businesses, liquor. You have Prestige, which is a real estate play, but in a sense, it's also a consumer play. You have autos, which is also a consumer play. So, what is it?
No, that's already
Thematically,
there.
what is?
So if you look at our top 5, or top 10, all those companies will be there except for those two restaurant businesses.
Right.
I think that's the tail of the portfolio. Put it together, it'll be about 3% of our portfolio. Okay. But the rest of the businesses, like I said, those are the companies that have already done their thing. I spoke about aviation, which is also
Yeah.
a consumer-led business.
Yeah,
And I
yeah.
said that, look, the business has grown an anemic 6%.
Right.
This company has grown passenger traffic by 13%
Right.
because of an industry structure that took place.
Right.
So I didn't have to be optimistic on consumerism. I had to be optimistic on the last man standing. Okay, but if I look at it from today into the next 5 years, will 5% growth in passenger traffic help me help this business get significantly stronger? I express my reservation. Still, you find another market around it, which
Right.
we think he's found.
Right.
Okay,
Understood.
so consumers that are there in the portfolio, you can always go stock picking. So it's never going to be a portfolio that doesn't have a bank, it doesn't have a consumer name, doesn't have, but these are all isolated companies that are there. I'm not. So we run a portfolio which is a lot of active weights,
Right.
and those or at least with 90% active weights. And with 90% active weights, you genuinely have to go out and find companies that are making a difference in their
Right.
industry.
Right. Right.
That's all we try to do.
Right.
So whether it's a macro theme or whether it's a deflationary market, you will find a business that will make sense at a certain price point in the category that it operates in.
Sure. Anything else on which you have very strong views? Anything that you are particularly bearish on?
Again, use the word bearish. No, actually not. I like businesses that don't do well. Okay, because it creates a phenomenal opportunity for long-term investment in it. Some part of the financial market that is there, especially on the insurance space, uh, starts getting very attractive from a price point.
Right. Right.
Okay, but there are a number of other problems that exist in that business, which is why it is attractive at a certain price point. Okay, so within the banking lending space also, I think we come across one or two companies that can still deliver a 12-13% CAGR from now, and these are the large private sector banks out there. So that is also there on our radar. Now, when I talk about 12-13%, at least in the near term, I have from a portfolio construction point of view, I have a place to allocate capital to.
Right.
Okay, till I can find great opportunities out there, or till we find an opportunity which is like 2020.
Understood. Right. So, since we are talking at this time of the year and everybody is looking for outlook for the next year, so where do you see overall in general markets by next year this time?
Okay, we've been in a consolidatory mode, if not a negative mode, for the last 1 year.
Yeah.
Okay, I mean, if you are a long-term investor, you should actually hope that this year also ends up being the same.
So that is, you're hoping.
Yes.
So that means you will be thankful that it doesn't go down, if it doesn't go down.
No, I'll be thankful if it doesn't go up.
What kind of okay? So what
so
you
let
are
me
saying
address
is
the
the market
downside.
should stay flat and so that you will do well. Is that what you're saying?
No, I'm not saying either. So market is got a slightly negative points, and I'm negative. So it's not that we done anything rocket science last year. So
Right.
if market we will, after a point in time, be a reflection of where the marketplace is. But it helps to after a great 2020 or 2019 to 2024, okay, or 25. It'll be nice if the market consolidates a bit, because you get
Last
a
3
chance to
years,
breathe.
it hasn't done much.
No, it's done quite a bit. Indices,
2023 onwards. Okay, not last three years. At least 2 years, if you see, it's not done too much.
yeah, that's because
1 year is
last
flat,
1 year.
Yeah.
That if you take that last 1 year and you allocate and you take a CAGR over 2 years, yes, it's not done too great. Yeah, but yes, and just to explain that down cycle bit of it all, I'm not too optimistic you will get stocks very, very cheap. Okay, maybe in some category of capitalizations you will get that cycle that comes through, because a large part of that market is over invested at this point in time.
Right.
But from a headline marketplace, you won't get anything very cheap. See, remember, we went. It's not long time back that India INC went through a stress cycle. Okay, and when you went through that stress cycle and you came back with flying colors. You've been one of the best
Right.
corporate balance sheets in the world.
Right.
Okay, so I think corporate India knows exactly what to do.
Right.
So you may not get a significant downside, but you will get a time correction that can frustrate a lot of us.
In which pockets do you see that happening?
I think we already discussed most of that.
Yeah, consumers.
Right. So I'm not. So it will be a very cyclical market, so as to say, over the course of the next couple of years. Or that's what we think it is. Like I said, the consumer-facing businesses will hold up the economy for at least the 6 months. The next 6 months, we have to find a different story. It could either be government spending that will come back and come back. The following 6 months, you'll have to find something else that will hold up the market. So it would tend to be a very cyclical market, not the very best for an investor.
Right.
Okay, but if you've got the visibility of say a 5 years, maybe a 7 years time frame, because that's what you look for. Last 5 years, CAGRs have been north of 30%. If that's
Right.
what you're looking for, then you just continue to do your regular investments in the asset in this asset class, and I think you will have you will have maybe 2030, 31, 32 a compounding which will not disappoint you.
Fair enough. Um, where do you stand on, you have metals, but precious metals, gold and silver are going through the roof. Do you have a view? Do you invest? Do you personally allocate assets to these?
Uh, I never had a view on something like this. But if you're if you're in an economy that has a depreciating currency, it's a great hedge. It's been a great hedge all the time. Okay. Uh, I mean, I don't understand the fundamentals of gold or silver except for for the flight of capital away from
The dollar.
physical currencies,
Right.
dollar, yuan, rupee, etc.
Right.
Okay, so that's forming a part of everyone's portfolio today. But I do not have a fundamental view on any of these metals from a demand supply point of view.
Understood. So, can I just one or two last questions? Last 1 year, are there any new lessons that you've learned in the market? Anything that sort of got reaffirmed? Anything like that? And one advice you would like to leave our viewers with?
So you can't time your. I mean, it's not something that I learned last year, but it keeps coming back to
Right.
reinforce itself, because there have been some individual portfolio stocks that we've been very optimistic about, or it was a reasonably large weightage on the portfolio. But it keeps coming back to say that whatever you're bullish, whatever you are extremely optimistic about, the cycle never plays out the way you expect it to. Sometimes it's an extended long-term cycle that is there. I think it just keeps coming back to reaffirm itself, right?
Right. Right. And one advice
One
to
advice
navigate
to
next year.
Okay, I think this is something that I tell my entire team and most investors, is that you don't necessarily need to be at all the happening parties at all points in time, right? You stay in you stay in the party that you enjoy the most, or you have enjoyed the most. Chances are that you're going through a slack period; it'll keep coming back again.
Right. You stay at a place where there is no party, and then a party begins.
Fair enough. If you're throwing one, surely.
All right. On that cheerful note,
Super.
thank you so much, Kenneth. Such a pleasure talking to you today.
Thank you
And
very much,
wish you a
Mahalakshmi.
very happy Diwali once again.
Yes, wish you and all your viewers and the team a lovely season ahead.
Thank you. Thank you so much.